Good day. How are you? I hope you are fine. Today, I'm very happy as this is the last video for the corporate finance series. I'm glad that I have created 18 videos for the corporate finance series over the last 3 months. The topic of this video is private equity. How does the private equity industry add value to the companies it invests in? And what does this mean for investors? This video presents the fundamentals of private equity. Along the way, this video will explore what a private equity fund does and how it is organized. At the end of this learning session, it is hoped that students will be able to define frequently used private equity terms, describe the activities, aims, the fund structure, the investment process, and exit strategies. It is widely recognized that the private equity industry is subject to massive booms and busts. This video also presents some empirical evidence of the performance of private equity. Stay tuned and let's learn together. Private equity can be defined as any equity investment in a company which is not quoted on a stock exchange. Private equity is not public equity because it includes investments realized outside the stock market. What are the key activities of private equity firm? Is private equity a form of financing? What kind of companies would private equity firm potentially invest in? What are the aims of private equity firm? I'm sure you can derive the answer from this slide. The Security Commission Malaysia publishes the list of registered venture capital management corporations in Malaysia. There are 67 registered companies on the latest list. Who invests in private equity? According to the statistic from British Private Equity and Venture Capital Association (BVCA), in 2019, the largest investors in private equity are banks (38%), followed by sovereign wealth funds (14%), and insurance companies (9%). Take note that the BVCA report is a good source of information and reference for private equity sector in UK. This figure shows an overview of how a private equity investment fund is organized. The fund is a limited partnership, not a corporation. In a private equity firm, investors band together with fund managers in an investment partnership. Investors take the role of limited partner, while managers take the role of general partner. What are the differences between limited partner and general partner? The limited partners invest the money. The limited partners have limited liability and do not participate in management. In contrast, the general partners have unlimited liability for the liabilities of the fund, but is able to undertake the management of the partnership. Private equity fund managers have five principal roles. The fund managers would first raise funds from investors. Second, the fund manager would source for suitable investments. After the right investments are identified, the fund manager would negotiate and structure the deals for acquisitions. With many investments, the fund manager would manage the portfolio actively. The last role involves realizing value from investment through exit strategy. Is private equity investment liquid? The answer is no. This is because the investments of private equity are drawn down into different companies and are made over time. Limited partners are often required to commit their capital for the entirety of the fund's life, typically 10 years. A fund's lifetime is typically broken down by an initial 5 years investment period, followed by a 5-year divestment period. Because of the long-term nature of its investment strategy, private equity is illiquid. How does private equity add value? Private equity investors work together with the company's management team in various ways, including setting the strategic direction, improvement of operations, execution of strategy, cost reduction, improvement of IT infrastructure, entering new market, and improving competitiveness. How does private equity firm ensure that the investment add value? An executive from the private equity firm is placed on the board of an acquired company. The objectives are to promote effective organizational change, provide keen oversight, and disciplined decision-making. Private equity firm also ensures that the management team in a company has an ownership stake to align the interests between the company and the private equity firm. Let's have a quick quiz. If you were to select two most important responsibilities of private equity portfolio manager, which two would you choose? The answer is cash management and manager selection. This is because when the right management is selected, company can do well in various departments. Cash management is important for investment and survival of business. Private equity funds are clearly buy to sell investors, not buy to hold. This discipline helps all parties to focus on the creation of value during the holding period. The sale will tend to take place somewhere between 5 and 7 years after the original investment. Exit usually occurs after significant operational changes and improvements. The common exit strategies include listing on the public markets or initial public offering, selling to a strategic buyer, or selling the company to the management. Any investment decision, irrespective of its size, always begin with the same question: what gains do we stand to make? Due to high leverage, the risk of private equity-backed firms defaulting on their loans is a source of concern, and has raised questions regarding its impact on the stability and survival of these companies. The financial crisis and resulting recession have further incited this debate as private equity firms begin to experience greater difficulty both in raising new funds and refinancing debts for their existing portfolio companies, prompting academics to re-examine whether the industry is still creating value at this new age. It is important to understand the long-term performance of private equity in terms of value creation for investors. We shall look into two research articles on the performance of private equity in the next few slides. Stay tuned. In year 2014, Harris, Jenkinson, and Kaplan studied the performance of nearly 1,400 U.S. buyout and venture capital funds. The sample periods range from 1984 to 2008. They use a new data set from Boogies. The Boogies data are derived entirely from institutional investors, that is, the limited partners, for whom Boogies system provide record-keeping and performance monitoring services. The findings show better buyout fund performance than has previously been documented. Performance consistently has exceeded that of public markets. Private equity outperformed the S&P 500 by average of 20 to 27% over a fund's life and more than 3% annually. However, it is important to note that venture capital funds outperformed public equities in 1990s but underperformed in the 2000s. In year 2013, Wright and Wilson studied 153,000 insolvencies for the sample period 1995 to 2010. It was found that the default rate for UK private equity-backed buyouts is 5.3%, which is lower as compared to 5.7% for non-PE backed buyouts. The research also finds that the likelihood of failure is significantly associated with higher leverage for all firms, but has to be analyzed in relation to interest coverage, the capacity to service debts. Therefore, leverage is not the characteristic that distinguishes failed buyouts from those surviving. It is widely recognized that the private equity industry is subject to massive booms and busts. For example, private equity has been in hard times during the financial crisis in 2007. Private equity buyouts are often financed with high leverage of 75% debt and 25% equity. Therefore, it is not surprising that private equity deals have been hit hard during the credit crisis. Moreover, investment patterns in private equity closely follow IPO market cycles. Since private equity investors often invest with a view towards exiting via an IPO, the weak IPO market affected the return of private equity. Applebaum and Rosemary in 2014 note that the private equity industry participants published very positive reports, while finance economists provided more modest empirical results. It has been a controversial issue whether private equity investments deliver on their promise of returns that are substantially above the stock market. Central to this controversy is the fact that private equity's lack of transparency. Private equity firms are largely exempted from disclosure requirements. This makes independent analysis of its data impossible. The studies of performance suffer from incompleteness because there is no publicly available or comprehensive data on private equity. The main obstacle for detailed value creation analysis is the lack of detailed transaction. Little is known about value creation of private equity. Industry reports are also biased, as they rely on the data and methods of self-interested parties. Different methods of calculating returns yield different results. Reports that private equity funds substantially outperform the stock market come almost entirely from industry sources that use the internal rate of return as a measure of performance. This measure is deeply flawed, and many finance scholars reject its use. In this slide, I draw together the major criticisms about the private equity sector. One major strain of critique of private equity is that it is short-termist and does not build long-term value. It is claimed that private equity is about cutting jobs, stripping assets, de-recognizing unions, and exiting the business in a short time horizon. This is claimed as value extraction, not value creation. Critics have argued that many deals are being completed with levels of debt that are too high. Using excessive levels of debt to acquire corporations generates risks. The argument is that these risks are borne by wider stakeholders of the business, including both employees and creditors. Neither of these groups benefit from the increased rewards from taking the risk. A lack of transparency and the use of flawed measures of fund performance may mislead limited partners who invest in private equity funds. This leads to disappointing investment returns. Before I end this video, I would like to introduce this association to you, the British Private Equity and Venture Capital Association, which is a good source of reference to learn more about private equity in UK. I particularly like the report entitled Examining Private Equity's Place in Investors' Portfolio, published in 2015. I encourage you to visit the website of BVCA to find out about their annual reports and the latest research publications about private equity. Finally, we have come to the end of this video. I have the vision of making my educational videos open to the public after the COVID-19 pandemic lockdown to encourage sharing of academic knowledge. If you like this video and find this video beneficial for others learning, please click like or share. I welcome you to subscribe to my YouTube channel too. See you and goodbye.